video covers applying the PP&E accounting rules. So we'll go through two examples of actual companies and we'll work with their disclosures and apply some of the PP&E accounting rules that we learned. Okay, so let me get them out of laser pointer. Go to the next slide. So the first thing we're going to do is apply what we know about how to account for a sale of property, plant, and equipment. And we're going to just do a thought exercise using Target. And here I've shown you Target's consolidated statements of financial position. That's another word for balance sheet. So this is Target's balance sheet, and this is just the assets section of it for the period ended February 3rd, 2018 and January 28th, 2017. So they've got kind of an odd period end date that falls on different days every year. Anyway, we're going to just imagine what would happen if Target decided to sell all of its property, plant, and equipment on February 3rd, 2018 for $30 billion in cash. So here's their property, plant, and equipment. It kind of starts here, and then they list it all out. Land, buildings, fixtures, computer hardware, construction in progress, accumulated depreciation, and the net balance of 25 billion. Let's see, yeah, this is in millions, so 25 billion essentially is their net PP&E balance. And so what would happen if Target decided to sell all of this PP&E for $30 billion in cash? Well, first I want you to think about this question conceptually. So this is, their PP&E has a book value, otherwise known as a net book value. By the way, the gross book value would be just the book value of all these assets before you subtract accumulated depreciation. So these numbers, if you add these together, that would be the gross book value. After you subtract accumulated depreciation, well, now you have the net book value. And so property, plant, and equipment has a total net book value of 25 billion. If you sell something with a book value of 25 billion for 30 billion in cash, your intuition should tell you that you have a $5 billion gain. So that's what we're expecting to see when we go through the journal entry here. After we do all of the parts of the journal entry, we should expect to see a $5 billion gain, because we're selling something with a book value of 25 billion for $30 billion. So let me go through this journal entry with you. And the first part of the journal entry is a debit to cash, because Target is selling their PP&E balance in cash. And by the way, this sale is happening February 3rd, 2018, which is, the last day of the year. Okay, so these are the accurate balances as of that date. And the debit to cash is coming into the business, $30 billion. And this is in millions here, so $30 billion. Next, what do we have to do? Well, they're getting cash, but they're giving away all of their property, plant, and equipment. So they need to take all of these balances off of their balance sheet. And so all of these positive balances here, these are positive asset balances. And so they are debit balances. So we'll get rid of them with a credit. Accumulated depreciation, that's a credit balance. That's a contra asset account holding a credit balance. So we'll get rid of that account with a debit. And let's do it. So the land, it's at 6095, and that's a debit balance. So we'll credit land for 6095 to get it off of our books. We'll credit buildings and improvements for 28396. Credit fixtures and equipment for 5623. Credit computer hardware and software for 2645. Credit construction in progress for 440. And then, so those are all credits. To get rid of these debit balances, send them to zero. And then we want to zero out accumulated depreciation. So that's a credit balance. So to zero it out, we need to debit the account. And we'll debit the account 18,181,000,000. Okay, so here we are. We've received our cash and recorded it in our journal entry. We've given up all of our PP&E, and so we've recorded that in our journal entry. But our journal entry doesn't yet balance. So if you were to sum up the debits and sum up the credits, you would see that you need another credit of approximately $5 billion to balance this journal entry. And so that is a plug in this journal entry. You plug it, you calculate it. And the amount of it is $4.9 billion. And that goes to a gain account on the income statement. So on the income statement, you might have a caption on there called gain on sale of property, plant, and equipment for $5 billion. That's what Target would be reporting on their income statement if this transaction happened, okay? So at the end of the day, what would happen? Well, the balance sheet would have $30 billion more of cash. It would have zero property, plant, and equipment or accumulated depreciation. And then the income statement would show a gain of 4.9 billion, and that would be closed to retained earnings. So that at the end of the day, what happens to the balance sheet? Well, cash, the assets total effect, the assets go up by 4.9 billion because they go up by 30 billion and down by the book value of PP&E, which is 25 billion. The net effect of equity is up 4.9 billion because this gain gets closed to retained earnings. So assets goes up by 4.9 billion, equity goes up by 4.9 billion, and assets continues to equal liabilities plus equity. So the balance sheet equations maintain. Anyway, okay, so that's just the thought exercise of how to sell PP&E. And when the proceeds from the sale are different from the book value of the asset you're selling, you record a gain or a loss, depending on whether the cash is more than the book value or less than the book value. All right. And the second example we'll go through is an impairment analysis of property, plant, and equipment. So let's just remind ourselves of the impairment rules for property, plant, and equipment. This is a two-step process. Step one is here. You take a look at the undiscounted expected future cash flows that the company is going to receive because they have this property, plant, and equipment. So a certain piece of property, plant, and equipment like this chair is going to generate cash flows in the future because it's so comfortable, I'm going to be more productive, okay? So this chair is going to generate cash flows in the future. I could make a list of those future cash flows and then sum them up. So what is the total future cash flows that our company is going to have thanks to the fact that we have this chair? That's what this first square is here. And we're going to compare those cash flows to the book value of the asset. So I think this chair is going to generate $500 of future cash flows. The book value of this chair is $1,000, so it's higher than that. Is the sum of undiscounted cash flows less than book value? Yeah, it's $500. The book value is $1,000, so we need to proceed to step two. If it's not, then you can just stop and record no asset impairment. So once the undiscounted cash flows are less than the book value of the asset, then you discount those cash flows. And when you discount the cash flows, you arrive at the fair value of that asset. So if I were to take the $500 of future cash flows associated with this chair and discount them to today, so what are those future cash flows worth today based on some interest rate as a rate of return? It's somewhere less than $500, okay? So $500 in the future is worth less than $500 today. And so whatever it's worth today is the asset's fair value. And what you would do if you proceed to step two here is you would write down the book value of the asset to its fair value. That would be an impairment. So let's just look at an example now. And the example we use is Apache, which is an oil and gas company. And they've got property, plant, and equipment, which is primarily oil and gas wells and properties. So if you look at their property, plant, and equipment balance, it's the total net balance here is 18.4, and this is in millions, so $18.4 billion is their total property, plant, and equipment balance. And that's if you take all of their properties and gross assets and subtract accumulated depreciation, depletion, and amortization of 28 billion, you get to the net book value of their property, plant, and equipment balance. They're just calling it property and equipment, okay? Something else that oil and gas companies only disclose is an idea of what are the future cash flows that the company's going to have from its properties in the future, okay? It's a required disclosure for oil and gas companies because investors want to know, hey, how much oil are you going to be producing? And how much cash are you generating from that oil and gas? And so here's the table where they disclose that. So they're going to have future cash inflows of $48.9 billion. They're also going to have production costs in the future. So they're going to incur production costs of 18 billion to develop all those assets. They're going to have other development costs of 5.6 billion to develop the assets. They're going to have income tax expense on that income of 3.8 billion. And they're going to have net cash inflows from those assets. And this is undiscounted. So net undiscounted cash flows from those assets of 21.4 billion. And then they're required to apply a 10% discount rate to those cash flows just to give investors an idea of present value at the standard discount rate. This is called the PV10. So the present value 10% discount rate. So if you discount all these future cash flows at 10%, the discounted present value, otherwise known as the fair value, assuming 10% is an appropriate discount rate, would be $13.7 billion. So because Apache provides this extra disclosure, we can ask and think about some questions about PP&E impairment. So question one, should Apache have recorded a write-down in 2018? Okay, so we're pretty sure they did the accounting right. Okay, this is a big company and they were audited, so they probably did the accounting right. The answer is probably going to be no, but let's see how it's justified, okay? So step one is to compare the net book value of all their assets, which is 18.4 billion, to the undiscounted future cash flows. Well, the undiscounted future cash flows is 21.4 billion. So since the undiscounted future cash flows is greater than the net book value, that's step one, well, they don't have to proceed to step two. They can just stop right there and not record an asset impairment, okay? They stop at step one. But let's kind of figure out how they would record an impairment. So let's suppose instead of adding up to 21.4 billion, this number here added up to 18 billion, okay? So the total net cash flows was 18 billion. And let's just assume that these cash flows are really soon. They're going to happen really soon. So actually the effect of the discount rate is going to be lower, and they're going to have future discounted cash flows of the same amount. So that's what I'm trying to do. So then the undiscounted cash flows goes down to 18 billion, but the discounted cash flows just remains the same at 13.7 billion. What would happen then? Well, let's talk about, no write down there, and they did the correct thing. So step one in this new scenario would be to compare the 18 billion of future undiscounted cash flows to the $18.4 billion in net book value. And the undiscounted cash flows is less than the current net book value, okay? So that means that we'll need to proceed to step two of the two-step PP&E impairment test. And step two is to calculate the impairment. So the impairment is equal to the book value minus the fair value, where the fair value is the discounted future net cash flows of 13.7 billion. So 18,421, we need to write that balance down to 13,721. So the amount of our write down is $4.7 billion. So what Apache would do if this were the scenario, and there is some flexibility as to what accounts are involved here, but the account I prefer is let's just accelerate depreciation expense. So we'll debit depreciation expense for 4,700 and credit accumulated depreciation for 4,700. And that would increase this accumulated depreciation balance, make it more negative. They would make this accumulated depreciation balance more negative, and it would reduce the net book value down to 13,721. That's the effect of this journal entry. The effect of this journal entry on the income statement would be more depreciation expense, $4.7 billion more depreciation expense. And so that's how you apply the two-step PP&E impairment test. And let me just say one thing about this two-step test. It's meant to be, avoid asset impairments for companies with property, plant, and equipment, okay? So you could have a scenario, and in fact, the reason I picked Apache is they do have the scenario where, assuming 10% is a fair discount rate, the fair value of Apache's property and equipment is lower than its book value. Do you see that? So this Apache has a book value of equipment, property and equipment of 18.4 billion, but the fair value of that property and equipment is only 13.7 billion. So an investor looks at the balance sheet and says, oh, look, they've got 18.4 billion of property and equipment. That investor is somewhat misled, because that $18.4 billion book value exceeds the asset's fair value, what the assets are actually worth. So when you have property, plant, and equipment, you could have the scenario where the book value you see on the balance sheet is greater than the fair value that actually is the true fair value here. And the reason that can happen is that we have a two-step impairment test. We allow companies to not record an impairment if these undiscounted future cash flows are greater than the book value. Then we allow a company to skip an impairment even if the discounted future cash flows are lower than book value, which was the case with Apache. Okay, so those are the two examples I wanted to go through, just applying some of the rules we learned about in the property, plant, and equipment topic. So I hope you had fun, and I will see you next time. Bye-bye.